Back on Lance Beggs from YourTradingCoach.com. Today we're going to continue our series on price bar reversals, reviewing the hook reversal pattern. Once again, like the previous reversal patterns, the hook reversal can exist at either a top or a bottom reversal. So let's examine the top reversal first. Occurring at a market top obviously would require a setup involving price trending upwards to the pattern, as shown here. And if it trends up into an area of resistance at this level, then it's just about perfect. The hook reversal then forms here, and you'll recognize it via the criteria listed on the left of the screen. Firstly, it forms an inside bar. That means that the high of the hook reversal at this point here is lower than the previous high here, and the low of the price bar of the hook reversal price bar at this point here is above the previous low at this point here. In other words, the whole range of the hook reversal bar from low to high fits within the range of the previous price bar from its low to its high. Now, inside bars by themselves are great. They reveal a lot about the price action, showing a pause in the current trend, and many traders look for entries off inside bars, particularly if it's also the narrowest bar of the last 4 or more bars. However, the hook reversal is a special form of an inside bar, having additional requirements such that the price opens up near the high of the bar and closes down near the low. So to summarize, we have an uptrend, then a pause in the trend identified by an inside bar in which the price opens near the high and closes near the low. Confirmation of the pattern will be price trading below the low of the pattern at this point here. Of course, if you like a little more confirmation, you might prefer to wait for a close below the low, or even price trading below the preceding bar at this point here. Same deal for the stop loss. A stop should always be positioned where price should not go if the setup is to remain valid. Of course, that's flexible depending on your assessment of the price action. It may be above the hook reversal bar at this point here. It may be above the preceding bar. Just be sure it's at a spot which says to you that either your analysis was wrong or something has changed in the market. Either the way, the setup's invalid and it's good to be out. Let's consider the psychology of the pattern. There's clear evidence of bullish sentiment as price is trending upwards. You may note on your screen that in this case it's almost a perfect example, with each price bar having higher highs, higher lows, and higher closes. Of course, it's rarely as perfect as this in real life, but whether you get a perfect example or not, we need to have a bullish trend extending for a period of price bars. Price then forms an inside bar at this point here. What does an inside bar indicate? It's often stated that an inside bar displays indecision. What it actually displays is a short-term balance between supply and demand. Price rose while the demand of the bulls was stronger than supply available from the bears. At this position here though, either the buying dried up or the selling increased, resulting in more of a balance. Perhaps price has risen to an area of previous resistance, encouraging some of the bulls to lighten their position and take partial profits, and encouraging some bears to enter the market short. Whatever happened, if demand had continued to overwhelm supply, then price would have risen further. But it didn't. And if supply had increased to overcome demand, price would have fallen. But it didn't. So does forming an inside bar change the sentiment to bearish? No. It demonstrates a change from bullish sentiment back closer towards neutral. Let's look at the price movement though inside the price bar to see which party, the bulls or the bears, dominated that time frame. Price opened in the vicinity of the high up here, and while we don't know the exact path of movement, perhaps it simply went from the open to close, or it could have just gone up and down the range a couple of times. In any case, it ended the price bar down here with the bears clearly dominant, in that they were able to overcome all bullish demand and close the price down near the low. This is why they classify this pattern as potentially bearish. Of course, there's no guarantees, which is why we seek confirmation through price trading below the low or closing below the low depending on your risk profile, and it's why we use a stop to protect our capital from excessive loss when the reality of the market differs from our analysis. A downtrend and bottom reversal work the same, just reversed. Price trends downwards, ideally into an area of support. An inside bar forms. However, it's not just any inside bar, it's one in which price opens near the low at this point here and closes near the high, showing a reversal of direction compared with the preceding trend. That price bar is your hook reversal if confirmed. Confirmation this time is with price trading above the high at this point here, and the stop loss is positioned below the low of either the hook reversal or the swing low down here. And the psychology is the same as the market top, once again reversed though. Bearish sentiment is dominating the market as it pushes prices lower. Ideally we move right into an area of support, but we're not always that lucky. Either way, a change in sentiment occurs, increasing demand sufficiently to halt the downwards trend and form an inside bar at this point here. Now, while an inside bar is not overly bullish or bearish, looking at the intra-price bar sentiment in this case shows a clear victory of bulls over the bears. The price opened near the low and the bulls were able to drive price higher to close near the high. Confirmation through price trading above the pattern here will show a continuation of the bullish sentiment, an increase in order flow through shorts covering their position, and bulls entering long will potentially assist to drive prices higher. So the hook reversal at a market bottom is a short-term bullish pattern. Let's see some examples. Here's News Corp on the daily chart. A quite rapid move down, accelerating through this part here, and then slowing at this point into an inside bar which opens near the low and closes near the high. A hook reversal. Price actually gaps up the next day to confirm the pattern and change to an uptrend. Of course, you don't necessarily know it's a change of trend at this stage, just that the short-term sentiment has changed and price is simply trending upwards on this swing. However, the next downswing could not break to new lows, leading then to an uptrend. Alright, let's go to Australia and look at the Macquarie Infrastructure Group. Large downtrend. Halted by a bullish rejection bar. A test unable to break through to new lows. Another test, this time on reduced momentum, back down to the same area. An inside bar, the little blue one at this point here, opening in the vicinity of the low and closing near the high. I'd ideally like it a bit of a larger range than this, but technical analysis is rarely perfect, and most importantly it's set up really well in terms of market structure, with the bullish rejection bar, a test and then a retest. The retest occurring in the same position as the previous failed test. A break above the bar leads to a nice little swing trade back up to test the previous highs. Okay, so coming up in the next video we're going to look at the key reversal, and then we'll follow that up with the island and pivot point reversals. I look forward to speaking with you again soon. I'm Lance Beggs from www.yourtradingcoach.com, wishing you as always many profitable hook reversal patterns.